hosted by PM Insights. I'm Nick Fusco, your host, and today I'm joined by Jim. Hey, Jim, would love to get to know you a little bit better on the show, understand who you represent and what your focus is in secondary markets.
Thanks, Nick. Glad to be here. Appreciate you taking the time to chat, and looking forward to talking more about private markets and secondaries and everything else.
So usually what we want to get a sense of is who you are and what do you do. Really pretty straightforward, like from Kindergarten Cop. Who's your daddy and what does he do? So would love to know who you represent and what type of clients you look after in the space before we dig into more of your background and focus for the future.
Yeah, so, deal sizes range anywhere from $1 million to over $100 million. With that, obviously very institutional focus. I'd say about 80% of the folks I deal with are institutions. So whether it's an early stage VC who's selling all the way through a growth fund, hedge fund, asset manager who's buying, and everybody in between, that other 20% that I deal with are your common shareholders, worked with current employees, former employees, directly with management on secondary opportunities.
Very, very cool. So one might ask here, or my curiosity is, how are you getting up to $100 million size transactions? What's your background? Where did you start? Did you work in the research field? Did you come from public markets? Would love to just get a sense of how you found yourself migrating to this end of the private market that really hasn't been around for more than a decade.
Yep. Yeah, great question. I have a unique background. Out of college, started at FINRA, so I was on the regulatory side of things, focusing on broker-dealers, audited from Morgan Stanley down to two-man shops in downtown financial district. I was there for a few years, then moved on to Strategas Research Partners. I was there for over 6 years. Helped out in the private market transaction group, which is where I got exposure to the private market and secondaries. The gentleman who ran that group that I worked with, he was kind of a first in on this market back when Facebook was private in 2009, and he was doing secondaries there and kind of took me under his wing. With Strategas, I did everything from those private market transactions to helping out their asset management business from scratch, 0 AUM to over 500 million, and also worked on some ops and compliance things on the trading desk. So really good exposure there, great experience, learned a lot, and from there been out, now on my own. It's been over 5 years doing secondaries and working on those secondary transactions.
Great. And I'm curious, what from your background really helps you navigate this market or gives you that competitive advantage? And I think competitively, you were also a professional cross player at one point. Is that right?
Yep. Yeah, very briefly. Cup of coffee, maybe even a shot of espresso. It was, again, another really good experience. I played Division I lacrosse, was a 2-time captain, and was picked up by one of the pro teams. And yeah, I think that's the nature of who and what I am. Hardworking, disciplined, focused person who kind of just grinds things out and does a lot of things that people won't do or willing to put in the work. So I do think that helps me with kind of a client service standpoint, doing whatever it takes to get things done for people and being responsive. I think all that stuff helps with who and what I am from that standpoint.
Absolutely. And I will say in this market, it's not putting in a limit order and hitting go, right?
Right.
So
yeah,
that commitment and drive is incredibly important. And where I'm going with this is, maybe is it because of your background in regulatory, in research, and the competitive nature of being in the space, whether it's sport or finance? Is it the marriage of those three qualities really that's helped the most, or what do you feel was the springboard in really putting you in the driver's seat to manage what you're doing today?
I haven't really thought about that, but I think you've hit it on the head. I think that's my unique blend from a competitive sports background my whole life, mixed with understanding the operational infrastructure of financial services to then deal making with secondaries is very unique. I honestly don't know of too many people that have kind of crossed the chasms of all of those. And I think, me as a person, along with that experience, will, is evident of what I've done now and what I will do even bigger in the future.
Super helpful. And working with you for the last few years has been great from a PM Insights angle. Just working with so many of the different broker dealers, bringing in bids, offers, and trades to really cement where we see the direction of the market going. And now in 2025, 2026 and beyond, a lot is changing, right? We have a new administration coming to market, coming to office rather, and I think that's also going to change the dynamic of regulation. So given some of your background, what are the core expectations beyond the surface level of, hey, M&A will heat up? What do you think will really change and how quickly in the next few years for our markets?
I obviously don't have a crystal ball. I can't really tell you how the new president and regulatory factors will, with the new SEC, looks like chairman will come in. It will be beneficial to private markets, public markets, and I think that's what we like to see. As someone from a regulatory background, you would think I'd want more regulation. I think there just needs to be a good balance between regulation. I think we need more clarity overall with kind of where things stand on the private markets. I know there's been talk about, where financials will be disclosed for private companies. I'm not sure that will ever happen. I think it would be beneficial at some level. As you know, with secondaries and things like that, it's tough to get our hands around how companies are doing and still keeps it wild, wild west. And we just need a better blend of that. And I'm not sure this administration is really going to lean in that aspect, but M&A will help with some of these companies that, are kind of off that venture track and will provide liquidity in some shape or form and just more euphoric sentiment in the public markets for IPOs and other liquidity options on top of what we do in secondaries.
Right. Yeah, and I think complementing everything that we're doing in our market, you are seeing a lot occur in the tender offer space as well. So I think more firms are just generally getting more comfortable with that process. And it's all a very nice complement to making sure that we're not getting too many bottlenecks on the liquidity front in advance of any IPOs. So would love to know, I mean, before the call, we were talking about, okay, are we going to see a lot of activity just leading up to year end and then just right after year end? I mean, a lot of folks are making tax decisions right around year end as well. I'm curious what you see as heating up for either stocks in particular, a sector in particular, or an activity type. Is it really sellers, buyers market right now?
Yeah, this has been like this all year. It's the tale of two stories. One of those stories in that bucket is a ton of activity, and you'd like to call it a flight to quality. It's the Databricks, the Stripes, the Andurils, the SpaceXs, OpenAI, and all the rest of the AI. That's where the majority of volume activity is happening. On the other end of the spectrum, and where I've been successful, is more one-off names as well. Buyers on the cap table has good information, and we're able to find that one-off seller who needs liquidity for whatever the reason may be, and pricing may be advantageous to the buyer, and we could kind of help each side out and get something done. So that's really the pockets there, along with all the stuff with these bigger growth names that I mentioned earlier.
Right. And one thing I think we tend to focus on is so many of the later stage companies comparing private markets to public markets is a focus on pure play. These companies aren't doing a million and one different product lines and business lines. And I think that's really, really beneficial, particularly for the administration coming into play, where M&A will be important, and they're going to want to focus on how do I get a very efficient business or attractive business that I don't have to disassemble in a million different pieces. So I'm curious, are we seeing better multiples on some of these pure plays, or better multiples just generally in the private markets still as we are in the publics? Or do we think that some of those multiples are going to start to get closer and closer to what we see in public markets?
Yeah,
I think.
to
unpack there, Jim. I'm sorry about that.
No, it's an interesting question. And as you know, the private markets traditionally lag the public markets, and feel like we've lagged much longer than the normal averages the past couple of years. I think that it needs to kind of play itself out with the AI angle, and kind of that's what's uplifting the majority of the private market opportunities we're looking at, where multiples are kind of what we were seeing 3-4 years ago across all growth names. So, can we even that out? Can we get closer to where the public markets are? And I'm not sure. I think private investors are much more disciplined this time round. At least I'm hopeful of that, and I think we will get closer to that. Software, I think it's around 5.5, 6x on multiples, and I think privates will always be more than the publics, but we may get closer to that in the future.
And I think just the understanding that this market is starting to look a little bit closer to publics in terms of
Yeah.
the amount of information, the infrastructure involved, which I think is really getting substantially better. And you mentioned your involvement 10 years ago, when it was really Facebook was the pre-IPO name of the day, and that in a lot of ways kickstarted this market. There was a lot of realization of, okay, we can get liquidity, we can move people in and out of these private names quite efficiently, and now it's not just Facebook, and then it's not just Facebook plus Palantir, and then when we had Robinhood, now like you're saying is you have the core focus on your top 20 or 30 names, your Anthropics, your OpenAIs, SpaceX's, of course, right? But it's way beyond that at this point, because people are getting the clues and bits and pieces to understand how to price up the 100th most liquid name. So I guess going in that direction, let's say I'm a client coming to you and I want to just get a sense of what's a fair price to bid at pick your favorite sector or pick your favorite company even. But if I was to bid on company Y, maybe just walk me through what are the things that a buyer should be asking of you, in the space. If you want to walk me through any of those questions you ask them or qualifiers, that'd be great.
Yeah, I think, there needs to be an onus on the buyer to do a lot of their own homework. And I think every buyer is different on how they operate in this market. Some need a high level of diligence, some don't. And I really go off of what that buyer is looking for and needs. And I try to facilitate whatever I can in the process. As you know, a lot of information isn't available, at least company information. So that is a hurdle, and I think will always be a hurdle. However, utilizing things like PM Insights, I'm able to kind of get a broader view of where bids and offers are in the name, where things have closed. And I just try to, going back to what you mentioned, I try to exhaust all of my efforts to find every bid and offer in a name that I could find across the market and provide that information to a buyer, and then they can make a decision. Not up to me to tell them what price or where I think they should go. I just could guide them based off of what I've been seeing in a specific name. And obviously I'll know some names better than others, but I think seeing closed transactions in names is, to me, the pinnacle of information. The bids and offers are great, but as you know, we are still in the wild, wild west, and a lot of the times half of those aren't real. They're not really that firm. So I like to see stuff that's closed and kind of know what's trading. And I think I'll add in block size as well. So a 200K trade that closes, and you're traditionally a $10 million buyer, we can't really link those because it's a totally different animal.
Right. And I think that's an interesting one, right? Because when we're trying to do proper price discovery and assuring that we're getting best execution, like fulfilling our fiduciary responsibilities for our clients, block size is incredibly important. And I think some people will come into this market and expect that, I've seen a whole bunch of $50,000 or $200,000 trades hit, but given you and I both have similar backgrounds, we've only been institutional, right, for our entire careers. Maybe do you want to hit on some of the pitfalls of utilizing retail style data to inform institutional size trades? So with expanding on your example there of, hey, I heard about a $250,000 trade, and now I'm trying to move 10 million. It's not really the same animal. So maybe if you want to hit on some of those pitfalls, would be great.
Yeah, you're just dealing with retail dynamics versus institutional, and in this market, there's a sophistication level in terms of knowledge and background, a retail buyer that's buying 100K of a name may not have all the information that a $10 billion growth fund might have. So there's an advantage there, and a buyer with a smaller block may pay more than you know someone else who may have other type of information that wouldn't pay that price. Just institutional buyers are traditionally more disciplined in how they operate versus the retail point of view. And I think there's opportunities and there's platforms out there to hopefully help retail folks get a better idea of where pricing is, but you're dealing with different types of sellers with different type of needs when block sizes are that small compared to an institutional seller that has very different reasons as to why they're selling versus a common shareholder who needs to offload 100K where.
Right. And I think one complement to that is sometimes you'll see the exact same price for retail and institutional, but guess what? You're loaded up with different SPV terms, right? So maybe you're sitting on the same price, but you've got a 2 and 20 for the retail versus the direct, that's just has to be a larger size.
Yeah, I mean, we could carve out a whole other 30 minutes on SPVs. I think that's been very interesting to see. I've done SPVs, I've ran them myself. It's been interesting to see how they've come to market. And in the past 6 to 8 months, with some of the names we mentioned before, we're seeing not only economics, but also one-time fees being added to these SPVs. That's been a new thing and really the norm. I mean, if they strip away economics, they go 0-0, they'll put a 10, 11, 12% one-time fee with folks getting allocations in OpenAI, let's say. Interesting dynamic there. I know I went off the track a bit with what you were mentioning, but yeah, there are these other SPVs for retail folks where they're paying. I've seen it. I've had my friends that are in wealth management send me things that they get for their clients, and I tell them it's way over, the premium's way too high to what I'm seeing, even for a retail. And it's unfortunate that people like that do that to people with those, try to cobble together smaller checks and make them pay all these fees and premiums to the trading price.
Right. And on PM Insights, not to plug it, but we do have an SPV calculator, which is helpful, particularly when you're looking at things that do have pretty egregious terms. You're going to have to really normalize that down if it was a direct or a 0-0 SPV.
Yeah, you want to know what your cost basis is. Yeah, when you're adding all those fees, it may not, on your books, it may not, but I mean, you're paying your calculator does a good job of showing what the actual price is. If you add in all the fees, you may think you're only paying $73.50 for Databricks, but it's really 92 with all the fees added in.
Yeah, exactly. And hopefully over time that begins to settle and it is more transparent about what folks are getting into. And I wholeheartedly feel the institutional nature of this market will start to resemble what we have in other OTC traded asset classes. But to that end, I'd love to hear what you think the future entails for a lot of, whether it's the infrastructure of the market, direction of, leave direction to later. But where do you think this market is headed? Is it going to be dead next year, or is it only going to take off, and why?
Yeah, I've changed kind of how I've thought about the future and the infrastructure part of things. I had always thought that this would go the way of the public markets. I feel like we are about 50, 60 years ago of the public markets. That's our current market and how we operate. Not standing on the curb necessarily, but pretty much the same thing. I think we are getting more institutionalized, and I think that's evident by the bulge brackets building out secondary desks. And with that, I think, to answer your question, it's positive going forward. I think we are only moving in the right direction. We've had some pain, some spinach we've had to eat the past couple of years, but I think we are headed to a more positive path with liquidity and opportunities in the private market. There's just too much equity that's locked up that needs to be released via liquidity, whether it's through us, through IPO or M&A. But we talk to venture capital funds all the time, and they do need liquidity. They're starting to need some liquidity, and there's companies that they'd like to get off their books, at least partially, and they're having trouble. And that needs to change. Like that, they need to show DPI to their LPs, and something has to give, whether it's through secondaries or otherwise. And I think there's just a lot of money that's put to work in startups in the growth world, and that will only continue. It's a great asset class. It's shown that throughout time, and I do not see that slowing down.
So to that end, now I want to hit you with market direction. We always ask our guests, is it going up, down, or sideways? And pick your time horizon. It could be the next 12 months, the next 5 years. But would love your take on where the market's headed directionally.
I think we've kind of a lot of companies have recalibrated, and the ones that did a good job are lean and starting to get toward profitability, which is what I think investors and the general market wanted to see. The free money era is over. I don't think we're going to see that for a while, and I think that's a good thing. I think it's disciplining investors, and it will only help the companies that they're putting money into. With that, I think we will. I'm not going to put a time frame, but for at least the short term, the next couple of years, I think we'll be in a better path than we have been in the past. This past year has been better than the year before, and I think that will just continue to compound as less regulation, more positivity, both in the public and private markets, and kind of a healthy reset in the private markets will carry us for a good bit of ways here in the future.
Yeah, and we've definitely seen a substantial number of those resets, and I think it is healthy. I would agree with that. It makes it easier for those names to start to rebound, reflect on what their core business is, and just continue to have those higher growth numbers than what you see in the public markets. So the way you see this market is it's not going to evolve like the public markets evolved from 25 or 50 years ago. So if it's not going to be a public market or one primary exchange or anything of that nature, Jim, where do you think this is headed?
Yeah, I think there will not be a winner takes all. I think we will see multiple, as we've seen now, many different marketplaces popping up or exchanges, as you will, and they all think that they will be the winner, and I don't know if that will be the case. I think there's too much fragmentation in this market and friction to allow that, on top of things that happen away from those marketplaces and exchanges. We just see it all the time. I think some of them are very beneficial, and I work with them and appreciate the service they provide. I just think that we will not get to a millisecond type of trading atmosphere where everything's automated, as great as that would be. I just don't see how that will work with the asset class we're in.
Right, and I think time will tell, but I very much agree, because having worked in the credit default swap market, the syndicated loans market, the asset-backed security market, there's no centralized path that everyone uses to transact. You have many different counterparties, right? That's why we have this podcast, actually. Know your counterparty. And
Yep.
It's different relationships, different specializations of each different broker-dealer or marketplace. I do tend to agree with you on that. And you're seeing, while market share is rapidly evolving, some of the mainstays of the market are decreasing in market share, but so many folks are coming in and taking new corners or segments of the market, right? So it's hard to disagree with where you see this going, and to that end for the future and the way the infrastructure is playing out too.
Yeah, I think it'll be interesting to see how that plays out. I had thought a few years ago that it would be centralized, and there were some leaders in that, and I don't think that's the case. There's just too much splintering, and folks like yourselves, and there's a lot of information in other places that you could obtain to help you, and I think it's just going to be a matter of cobbling it all together, and again, going back to what I said before, hopefully I provide a good enough service to get you the best information to make your decision as best as possible.
We really appreciate having you on today. And to close things out, I mean, what is the best way to reach you? Is it email, phone call, find you wherever you're located? How can we get a hold of you?
Yeah, I'd say email's the best, jim@anchorcapitalgp.com. From there, calls are great. I'm focusing more on calls. I think it's a quicker way. There's just too much noise with email and what the like. But LinkedIn too. Just find me there, connect, or message me, and I will get back to you to set up time to chat and go from there.
Perfect. And we'll leave some links to Jim on the LinkedIn post, Twitter as well. And truly appreciate the time. So
Thanks, Nick. Appreciate it.